You're almost always, in any economic scenario, better off owning assets that go up and appreciate through time. And remember, you still do get dividends from an ETF or an index fund or even just a share portfolio. You still get dividends, and those dividends come with franking credits. So whereas your 5.5% from a savings account, if you're on a 30% tax rate, it's going to fall to 3.5%. So really, then you subtract your inflation, you're zero.
The Get Rich Slow Club podcast is a collaboration between Tash Etchman from Tash Invest and Anna Christina from Perla. The Get Rich Slow Club acknowledges the traditional custodians of the land we record on. From coast to coast, across land, waters, and communities, we pay our respects to elders past, present, and emerging. Any advice is general and does not consider your financial situation, needs, or objectives, so consider whether it's appropriate for you.
Welcome to the Get Rich Slow Club podcast,
where we take you from beginner to confident investor,
where we can teach you everything you need to know about investing.
So come get rich slow with us.
Hello and welcome back. Today we have a very fun guest with us, Owen from Rask. We'll hear a little bit about him soon. But today we're going to cover some really important and big questions that we get. Things like, if investment returns aren't guaranteed, what's the point of even investing? And will the stock market ever completely crash? But first, money wins or losses. Do you want to go first, Owen?
Sure. Money win. I recently bought a American coffee maker off Amazon. It's called Ozpure, for anyone that's interested. And it's like a black coffee pot. Normally I'd get like a Breville or a DeLonghi or something like that. This was $57. And this was only 2 months ago, and I've since bought 3 more.
3? Why do you need 3?
I bought them for friends and family. I thought that was so good. And my in-laws, I got one for them and they absolutely love it. So
amazing.
Definite win. There's one in the office here. Yeah.
Wait, hold on. What is it? It's like what kind of coffee?
Like, like the drip coffee?
Oh my God.
In
Sorry. That's like, no, not the movies. My childhood, my whole life. I'm like, gross.
Yeah.
Oh my gosh. I totally.
Like diner coffee. Yeah.
I realize how special it feels for Australians, but like for me, oh my God, no.
Yeah. The thing is, it's different because we have good beans here as well.
Yes.
So if you drink a long black or something like that, it's still very good. Very, very good.
And what do you call that type of coffee? Like just drip coffee?
Just drip's fine. Yeah.
Yeah. Okay.
Yeah.
It's not bad. Sorry. It's not bad. It's
I think
just
being like in wonder, you're like, wow, but no, it was like an, oh God.
Yeah. And well, I guess it has that like weird nostalgia thing for me. And sometimes it can be really good and sometimes it can be really bad. Like my aunt's coffee always just like brings me back to like a special place. And then you go to a diner and I'm like, this is so gross. Please give me a piccolo,
Yep.
So to your point, it depends on the beans, depends on who's making the coffee.
Okay, money win for Owen, maybe not for Anna.
Yeah.
Yep.
I'll still have a cup.
Okay.
Yeah.
What's yours?
Mine is, so I'm usually really great at automating things. I automate everything. I automate my bank, my investing, everything. However, my kid goes to speech pathology and for some reason, those invoices aren't automated.
That's the most annoying thing ever.
Yeah, I had to pay an extra $40. I was 16 days late. $40. That blew my mind. That's so much money.
I hate how backwards some of those healthcare things feel. I go to see a psychiatrist and I have phone appointments. They call you for the phone appointment and then you have to hang up and call the switchboard and get transferred to then pay your bill, your invoice as well, like over the phone, which just feels not fun at all. And then I've tried to email before and they just won't let you pay like online at all.
That's random.
Yeah. Because you want to automate it. Like if I'm going regularly, if I'm going every 2 weeks, doesn't it just make sense to automate that?
Yeah, like
I don't have to worry about it.
Put your card on the system and just charge it, you'd think.
No, not the case. So $40 out of pocket. Someone suggested that I call them up, but I already paid it. So I feel like it's too late to see if I can get that money back.
And now you probably won't miss it again. You'll be aware.
Yeah, I'm angry still.
Yeah. Holding a grudge.
Yeah.
Mine's a bit more fun. I was just like looking on Google Flights the other day and I saw there was $500 flights to Kenya from Melbourne.
Amazing.
Wow. That's a long way.
Yeah, with AirAsia.
That's cheap.
So they've launched a Nairobi to Kuala Lumpur flight. And they're selling them for like $250 each. And then for some reason, KL to Melbourne was also $250.
Wow.
When are you going?
When or where?
Where? When?
Yeah, I'm going to Uganda and Kenya because I want to go see the gorillas in Uganda, which would be fun. But yeah, I'm going in March because flights were just like on special. And how could you not?
How did you find that?
I was looking at going to Uganda anyway, but the flights to the city in Uganda I wanted to go to were just like insanely expensive. It was saying it was $3,000 returns. And I was searching each segment individually. And just for some reason, like the Nairobi, I like thought about maybe going to Kenya because that was the capital city. And then Nairobi to KL was just like cheap. So I kind of just I could look at the maps and hop around to the major airports. So I was trying like Melbourne to Doha, Melbourne to Dubai, Melbourne to Nairobi in Kenya, like all these different places.
How long did this take you? Because I always find I spend so much time trying to find the cheap flight.
Yeah, maybe like a few hours, but I was like watching a show, just kind of like looking up different things. And then once I get into it, I'm like, wow, like I could go to like South America as well. Like where else can you keep jumping to? Yeah, like I look at like where the layovers are. Some of them had layovers in Cairo. So I was like, oh, maybe I'll go to Egypt as well, but not this trip. I don't have that much time.
Did you use the tracking thing, the price tracking thing where you can like toggle in Google?
No, I just like see what's on special in the moment. Because there's always like some way to get there cheap if you're like willing to fly to random places. Like on the way to Dubai, we stopped off in China because that was way cheaper than going direct.
Yeah, cool. That's a win.
Win, yes, fun.
Amazing.
You do so many different things, Owen. You have finance podcasts. You are a business coach as well. You used to be an investment analyst. You still are. Do you have a managed fund as well? Tell us a little bit about all the things that you do. Yeah,
it's pretty chaotic. So like 9 to 5 is Rask and what we do here. And that includes like podcasts, investing, all of those types of things, the education stuff. But then outside of work hours, I coach. I don't coach as many individual clients as I used to. And this is kind of like a big imposter syndrome thing, I guess, for me was like, I always thought that I was doing business wrong because there's books on it, but like the reality of running your own business is very different to what you see in like a Tony Robbins book, for example. Yeah, especially a media business. I find like a lot of business stuff is targeted towards like you have things that you sell, like products that you sell more, and then you grow more and more that way, and then you open more stores or you hire more employees. But this I feel like is completely different stuff that I've read. Yeah. And so that was kind of organic for me is Jordan, who co-hosts our business podcast. He's an accountant by training and he spends most of his time doing like tax returns and those types of things. But then he's increasingly spending more time on strategy. He could do a tax return for someone, but then if they made a bad business decision that he could see, like that didn't matter how good the tax return was. They just needed some coaching on how to make good business decisions. And so when he started working with me on the business podcast, I was like, he was constantly saying, hey, you need to share what you know and stuff like this. But I had this big imposter syndrome because I was like, yeah, but this is just one business and whatever. I'd studied and invested in business for a long time, but this was the first one that I'd run. But then he's like, well, why don't you just build a website and just put it out there and see what happens? And so I did that. And then within 2 months, there were like 360 people on the wait list. And naturally, that was pretty surprising. I took on a couple of clients and I thought, okay, this was interesting. And then increasingly, I was interviewing CEOs and stuff. And I would realize that when we'd have the conversations on air, there was very much like, suit and tie, look good. But then off air, they just like tell me all their problems. And it was very much the same problems that I was having. In fact, in many instances, I felt like Rask was way further ahead than everyone that I was interviewing in terms of like use of technology, marketing strategy, how we set up the businesses, tax and that type of stuff. And so we've since applied that. And so outside of business hours, I spend a lot of time doing that. We have another business called Inflection, which is smaller than Rask still, but it's probably not going to be long before it maybe even surpasses it. Amazing. And you're still an investment analyst as well? Is that like your job title from before? Yeah. So for folks that don't know, I spent a lot of time, previously I was at the Motley Fool and I spent a bit of time with funds management, research. So I would research the fund managers who are like the experts. I would pass judgment on them. And as a junior in the industry, that was quite surprising. But again, like I was investing for myself using platforms like Perla. I was researching companies and what have you. And I realized that when I'd speak to the fund managers, I was also doing more work than most of them. So it was kind of this, when we think about like entrepreneurship with imposter syndrome in particular, it tends to manifest in a way that you overcompensate. So the best analogy I've come across is like if you have a glass of water, you tilt it to one side, that might be imposter syndrome or some sort of issue, but then it comes flooding back the other way. And that's the kind of imposter syndrome overcompensating back to the other side. And so you find that with a lot of entrepreneurs and things like that. And it was definitely the case with me, not growing up with money and that type of stuff. I kind of overcompensated to become a serial saver, a bit of a miser. And so that's how that worked. But throughout my time, then I realized that, hey, we could probably help people do this. We started with courses and educating people. So that made sense. And then, my day job now is helping people invest. We've gone from having just memberships to now people can come to us, they can get a membership and then they can follow our strategies in Perla or whatever brokerage platform they're using, or they can get us to do it. And it's typically the people who are not engaged with finance get us to do it for them. Amazing. There's so many things to unpack here.
Today's episode, I want to ask you some of those harder investing questions that we get where sometimes I'm like, I don't know how to answer this. But we are going to do another episode on shares versus business versus property where we'll dive into more of your business owner stuff because I feel like there's so many nuggets of knowledge there.
Cool.
Do you have the first question, Anna?
Yeah, one of the biggest things that I hear people say all the time is like, what if the share market goes to zero? Like, what if I lose all our money? Everyone loses money. And usually this comes from people who don't know much about the share market or market fluctuations, but what happens if the stock market goes to zero?
Can the stock market go to zero?
Can it go to zero?
Yeah, I mean, well, technically anything could happen, but
that's the answer. That's it. Sorry.
Yeah. So
The end.
the bigger problem would be what happens if the internet goes down, because most of the stock exchanges around the world run on the internet, but so does everything else in our world. You mentioned healthcare, you mentioned like defense. Like everything runs on the internet, basically. We've migrated.
What was that thing recently where like flights weren't able to leave because some software stopped working?
Yeah, so that was CrowdStrike, which is a company, a cybersecurity company I think it's on the NASDAQ, and uses advanced AI to effectively defend Microsoft computers and servers. And so Microsoft had this tool embedded and there was basically an update overnight and it was kind of missed. And so it sent everything down. And so you got that blue screen of death on your Microsoft device. Anyone that basically uses Google or Apple, you will find everything's good. For everyone else, it was a problem. So it grounded flights and these types of things. But that would probably be the bigger issue, is those types of things. The reality of your shares going to zero is extremely unlikely, especially if you've got a diversified portfolio. So ETFs are very well regulated. You know this, I know you dealt with the compliance side of things plenty of times, but in the finance industry in Australia, it's very unlikely. If you own individual shares, I like to use this as an example for people to understand what I call asymmetry, which is this idea that you should always, no matter what you're doing, whether you're investing your time or your money or just your effort, you should also always know what the downside is and what the upside is. And this is an idea of thinking probabilistically. But if you know that the worst case scenario is one share goes to zero, you could have a portfolio of 10 shares, for example. If one goes to zero, the other 9 should compensate for that risk. And this is not something that many people understand, but a share can only go to zero, but it can go up way more than 100%. Same with ETFs. And so I'm not worried about zero case scenario. In the case that it would happen, there would be effectively what we call custodians. So these are financial organizations that sit behind the scenes and they effectively are independent of your brokerage platform or independent of your super fund. And they are where your money actually is. So a custodian stores that money, which basically means you've got multiple layers of redundancy. So even if your broker goes down, the money's not with them, it's with someone else. And then if they go down, well, that's probably an issue. But normally then the stock exchange also has records. So very unlikely.
Yeah,
but if
and I like to think if for some reason Australia is going like losing all of their money and everything is failing, there's probably bigger problems in the world than the stock market because it's very unlikely for that to happen.
Yeah.
Because for it to go to zero, that means like every company in the world would not be making money, would not be doing well. And what are we doing as a society then, right?
Yeah.
Like what is actually happening?
Yeah.
Yeah. Well, if you look at say war-torn countries, there are countries where this is happening right now. And some of those are functioning and some of those aren't from like a, developed nation's perspective. And the ones that aren't functioning are ones that probably never had a stock market like we know it today anyway. Or if they did, it was more like a barter system or like a physical market, like an actual stock market. Like the name of a stock market is derived from trading stock, which is sheep. And so that's probably what they have in place. And we would probably resort to something like that, where there's more like barter system or there's like a traditional trade-based system where, I walk out, I've got, 5 eggs that I want to sell and you've got, 2 bundles of lettuce or I don't know, and we just trade, right? That's probably what would happen. But like you said, if we're in that scenario, extremely unlikely. I don't see it happening. But if it did, that's probably what we'd resort to.
Yeah, and when we talk about like those countries where it does happen, it is very sad for the people there, but it is often like their currency loses value. So then they end up turning to using US dollars or other currencies to still buy and sell things in their country.
Yeah, there's alternatives.
Yeah, so it happens to a few, but not everyone at the same time.
Yeah, well, if you look at Zimbabwe, case in point, you're going to Africa. Zimbabwe, for a long period of time, measured the the value of their currency in the weight of the notes. So
I've seen the bundles people hold, like the bricks or like the wheelbarrows of stuff.
Yeah, because the numbers on them were virtually meaningless, but the paper could be weighed and therefore maybe had some value.
This was the Great Depression as well. There were photos of people doing the exact same thing.
So what led to a big part of the Second World War with Germany and Nazi Germany was actually the fact that they were in a depression and they had extreme inflation, and that created civil unrest, which then obviously created many other horrible things. But that was an example of how something happened in the financial system which resulted in something else in society. But that currency as well was really problematic for a long period of time. And you have it in Argentina. In Argentina, they just gave up on their currency and they just used the US dollar. And that's why these countries, Venezuela, are more susceptible to the token-based currencies like Bitcoin and that sort of thing than the rest of the world, where we take for granted a very stable financial system.
Yeah, and we have those like systems in place now, and we have like the RBA in Australia that is kind of trying to control these things so it doesn't get out of hand, hopefully again.
Yeah, and you're specifically referring to inflation, but they're also tasked with ensuring the financial system is secure. Same with APRA, which is our banking regulator. You could look at like the Federal Reserve in the United States, the SEC, and the IRS, the ATO in Australia. There's these different, Bank of England, all these different organizations that are set up and tasked with financial stability and financial security. And I think if you just look around you, we haven't had that issue since, we were fully controlled by the British Empire. We haven't really had any of those issues. So it's not to say we can't, but it's very unlikely.
So in summary, it's probably not all going to zero if you buy a diversified ETF, but be mindful that if it does, there's other bigger problems, I guess, happening.
Yeah, and absolutely. In summary, you would have assets across multiple different things, not just ETFs. You probably have some physical cash, some commodities, property, these types of things that people can't take away from you.
If we can get 5.5% on our savings, is it even worth the risk to try and get 7% from shares or ETFs?
Yes, it's the short answer, because inflation will be eating into the return that you get from your savings account. And the key point is that typically inflation is either at or slightly above the rate that you would get on cash, or it's thereabouts. In recent times, we've seen 5.5% in savings or even more in an offset account. But that extra 1 or 2% over a decade or two makes a huge difference. You're almost always, in any economic scenario, better off owning assets that go up and appreciate through time. And remember, you still do get dividends from an ETF or an index fund or even just a share portfolio. You still get dividends, and those dividends come with franking credits. So whereas your 5.5% from a savings account, if you're on a 30% tax rate, it's going to fall to 3.5%, right? So really, then you subtract your inflation, you're zero. Whereas if you've got shares, the extra few percent, you get a franking credit refund or just an offset, you're actually not comparing apples to apples. And I think that's a thing that people really miss. And also shares tend to respond inversely to interest rates, so that if interest rates come down and you're all of a sudden stuck with your cash, it's giving you less, your shares have already gone up. That's something that people miss. They think, when it goes down, I'll just switch across. But by then they've compensated more than the amount that the cash has dropped. So that's something that people miss because they think it's just, to switch across. But shares are forward-looking. We say they're forward-looking because they react to expectations. They don't react to what's happening today. So that's a really important thing to understand, is that by the time you try and switch, they've already moved.
And is that the same for, let's say, a mortgage? So you're paying off a mortgage. Let's say that's 6.5. Is it better to pay off your mortgage, or is it better to invest in shares?
I think the answer is, like, mathematically, that it's better to invest. But the reality is there's a big behavioral element that should be taken into account. If you're in a relationship and one of you does not like investing, I would say at least do some of the mortgage thing, and then maybe some of the investing as you slowly educate them on how to manage money and why investing still works. There are certain instances where you would keep cash in an offset account, and a lot of our community do that. But the reality is, again, it tends to move in advance of whatever you're doing. So the thing to understand here is that if you put your money in an offset account when interest rates are like 2%, you would have felt like, that's terrible, right? But theoretically, the return from shares wouldn't have been that much higher in theory. Now, they did go up, but we can forget about that for a moment. But now that it's 6%, it doesn't actually make a difference. It shouldn't make a difference because the return on shares, in theory, should be higher anyway. So that old trade-off is actually just mental accounting. So it's like a bias that you see a number from a different source and it looks like a better return, but really it's still relative to shares. It's still the same equation. Now, you could say that you'll make more money if you time the market. Like if you think the stock market's going to fall, let's say you had a time machine. If you do, look us up because I will pay you handsomely for use of that time machine. But what you could do is you could sell all your shares and just put it in cash, which obviously would be a wonderful decision, but we don't have that hindsight. We don't have that foresight. We don't have any of that. So the reality is that you don't know. So you don't necessarily prepare for that, I would say. You just stay invested and you ride out the bumps, the ups and downs. And if sometimes cash is better than shares, that's okay, but it won't be always like that.
That's such a good point. But I think so many people get stuck on not knowing if shares will continue to go up. How do we know that it will keep going up over the long term and there won't be like a massive stagnation for the next 30 years?
Yeah. So like Japan is the reference here. So for those that don't know, the Japanese stock market basically did nothing for like 20 years. So this is a really good point. And I think this is a risk that potentially index investors fall into, which is that they think that index investing is the only way because it's worked over the past 30 years. And so there's another bias that creeps in called recency bias, which is typically you take something that's happened recently and you extrapolate into the future as if that's normal. And what people misunderstand about this bias, in my opinion, is that recently could be 30 years in financial history. Recently could be 30 days. And so we don't know what the future holds. So don't necessarily just extrapolate what's happened right here and right now going into the future. So let's just talk about this problem. So what happens if we enter a period where stock prices don't keep going up? Well, that's a good problem that we would have to think critically now to how do we deal with that? Well, let's first understand why share prices go up. So when I looked at 150 years of US stock market data, what I found was that on average, the US stock market and the companies that constitute the US stock market increase their profits between 6 and 7% on average every year. Now, the long-term returns from the stock market in the United States are around about 11%, maybe a little bit more. So effectively, it's growing a little bit beyond the profit growth, probably because there's a nice little sandwich in there, which is dividends. So you add your dividends in, and all of a sudden, you start to get towards 10%. And then you think, well, why has it gone up that little bit more? And that's probably because over the last 100 years, interest rates have been steadily falling. And so you tend to see that. And you tend to see that play out in the form of, on average, companies get more expensive. That's because more people are investing and all those types of things. Now, if we take the case of Japan, in Japan's case, they obviously had this period where things kind of went nowhere. They had to do this crazy quantitative easing, which is basically code for the government buying stuff. And we had Paul Clitheroe, who's like a lord of finance in Australia. If you don't know who Paul Clitheroe is, I'd encourage you to go look him up. If you don't know, your parents would know.
Yeah, I'm going to have to Google him.
Yeah, so he's like, Scott's going to hate me if I said Scott, but he's like Barefoot Investor before Barefoot Investor. Scott's probably a bit bigger, but basically he came on our podcast and said, he did this presentation one day and I heard about this presentation. I didn't see it. So when he came on our podcast, I was like, I had to reference it and ask him about it. He did this presentation. I can't remember who it was for, but he walked into this auditorium and he only had one slide. And the slide was Australian population growth.
I was about to ask you about population in a little bit. So yeah, carry on. This is interesting.
So if you look at like Japan, obviously stalling and migration is not a thing, right? You don't really migrate and become a permanent resident of Japan. And so what he said on our podcast is that when I look around, I just see little economic miracles everywhere. I see people driving to work, taking the toll road, shopping at Woolies, going to the cafe, coming up with a new invention at work, installing a new tap for someone, building a house. Like these are all economic miracles. You're just running around each and every day and you're creating things and you're producing things. And if you take that and you think that that seems to make sense and you look at Japan, it's probably not that. You had this massive run up with like electronics and the revolution, like the Nintendo, all these types of cool innovations. And then you go into this period where population growth didn't really go anywhere. And you kind of have this natural slowing as the aging population, fewer children, that type of thing. So if that was to happen basically, you could probably see it in the economic data. The Australian stock market since the year 1900 has been the single best performing in the world, followed by the US and then South Africa. And
The Australian?
Yeah, number one in the world.
Really?
Yeah.
Interesting. Why? Why does the US get so much more attention then?
Oh, because it's the last 30 years. Recency bias.
Yeah, okay. Interesting.
Yeah. That's exactly.
Did you know that?
I remember reading something like that because also Australia wasn't really affected by the GFC. There was like a couple different things that Australia did policy-wise, right, at that time in order to kind of cushion everyone from what was happening around the world.
Yeah, our big friend in China definitely helped us out by paying BHP and Rio a little bit more, and everyone that worked for them. We're very grateful for that. But if you take the last 30 years, the US has monstered basically everything. But over 100 years, you can Google this. I think it's the Credit Suisse long-term stock market returns report or something. And basically it's updated every year until the end of 2023. Yeah, Australia's number one. Number two is the US. And I believe it was still number three was South Africa. If you went back like 5 years, it was South Africa number one, Australia number two, US number three.
Interesting.
The last 30 years, you'd probably see the US market. But again, if you took it in 2014, you'd probably see some of the emerging markets like China did pretty well. But now we think China's a basket case. It's funny how the world works. Anyway, so if you look at that, what are the common ingredients? Well, there's a very stable democracy, very strong property rights. There's net migration. There's all of these things there's dual income families in Australia. So men and women providing for their house, financially speaking. You've got so many different things that contribute to these economic miracles. But let's say, for example, all of that stuff that I just said just went way over your head. You're like, I don't know what this guy's on about. You don't need to worry about it because as long as you don't put all of your eggs in one basket, you'll be fine. So don't put all of your money in just index funds. Don't put all of your money in just stock picking. Don't put all of your money in just property. Don't put all of your money in just Bitcoin. If you do that, that's silly because of all the reasons that anyone could throw at you. Instead, don't prepare for a certain future. Just be prepared for any future. And so the way you do that is you diversify. You don't have just ETFs. You might also own a property. You might have some cash with Bendigo Bank and some cash with CBA, just in case something happens to Bendigo Bank, right? Like, for example. And that's the beauty of diversification and the world that we live in is you don't have to be dependent on any one thing. So don't try and find the next Australia over the next 130 years or whatever it is. Just, have a little bit of everything. And I think if you do that, you'll be fine.
Birth rates are dropping.
Yes.
What happens if population growth slows down significantly?
Or it just becomes stagnant or starts decreasing even.
Yeah, it's fair points. So, there's this other thing that's come along in the last 30 years, which people seem to forget about unless they really focus on it. It's a thing called the internet and software. And so you don't need as many human beings to do the same thing as you previously did.
Yeah.
So productivity is really important. And so in this instance, like we saw the United States, we talk about things like American exceptionalism, which is basically just based on them having the biggest defense budget in the world and tend to have no sick leave and holiday leave, and they just tend to work a lot. But if you look at what they've achieved, they've effectively exported to the world what is like a really good business model, which is like, technology, scalability, profit. And so you don't necessarily need a lot of people to run like Google search. Whereas in the past, if you had like a traditional agricultural business, you would need a lot of people. Now agricultural businesses can achieve far more output with far less people. Self-serve checkouts at Woolies mean that you might have fewer people, but you still get the same level of productivity and they can go and repurpose their skills and become more productive elsewhere. And so I don't get necessarily concerned about any one metric in particular. I think, there's a really important thing about, this is more of like a social debate. I'm not an expert in this, but if you read the book like Factfulness by Hans Rosling, who was a medical doctor that traveled the world and helped people.
Which that was?
Factfulness?
Factfulness, yeah.
Yeah, by Hans Rosling. It's an incredible book, probably one of my top 3 books of all time, probably the number 1, to be honest. And in that, he talks about how there's some major issues that face the world. And a lot of the times with those, and one of the major issues, by the way, was a pandemic, which we seem to have solved. But if you look at the developed countries, it's very common that all of the developed countries have declining birth rates because typically as you get more money and you become of means, you typically rely less on your children for labor and support. So in some poorer countries, what you typically find is that in the past, like 50 or 100 years ago, you needed more kids because you needed to work on the farm. You needed to do these things. But economics has this wonderful stabilization, I guess, inbuilt in it, which is that as you become of more means, you tend to end up in a situation where you have less kids. So a lot of the developed nations around the world have typically 2 children or less in a family unit, which means that the population stabilizes. So if you think about global warming or climate change or however you want to talk about it, one of the big issues is probably that there's too many people living on one round thing floating in space. So there's a good and a bad element to that. And I think that if you read that book by Hans Rosling, you'll get a sense of the world is probably in a way better shape than most people give it credit for.
This is great and very positive. I like it mostly. But yeah, I think it's such a good idea to look like. I might read that book as well. I haven't read it yet because it is hard when you consume a lot of media content and you're like, wow, the world's not doing too well. There's all this stuff happening. Like there is a lot happening still, but I feel like it can be very doom and gloomy on the media because that's what does well. But this has felt a little bit more positive.
Yeah, there's a website that's devoted to basically Hans's work, which is called Gapminder. If you just go to the Gapminder website and just do some of the quizzes, you'll get a sense of the world. And it's a true factfulness way of living. And it's a wonderful way to live your life, is not necessarily to think about all the negative things and have an echo chamber where you're surrounded by the same people on your social media feed because you like what they have to say. You should actively seek out people that disagree with you. And I think that book's a good introduction to that. And, you know, there's many other areas in which this applies to finance, but David Gardner, who's the co-founder of The Motley Fool and probably the greatest living investor of the past 30, living investor, you've still got Warren Buffett, so maybe not him, but he's like, over the last 30 years, he's the best investor I've ever seen. And he has this wonderful view of the world and the way you should invest. And it's make your investment portfolio reflect your best vision of the future. And if you think about like declining birth rates, that sort of stuff, that's a problem. You wouldn't invest there. Don't invest in things that are exposed to that. Invest in things that have the opposite effect of that. Invest in Tesla because they don't need a lot of people to make more cars than Toyota, you know? And so those are the areas where you can use that informed and optimistic view to invest in a world that's getting better. And it's basically underpinned by what Hans was saying in his book many years ago. And so that's how I tend to approach it.
Owen, this was amazing. I think you've provided such a positive outlook on investing. Where can people find more about you?
Yeah, you can just head to our website, www.rask.com.au. And yeah, sorry for the rant, but I'm very passionate about being an optimistic person. I think it's by definition, everyone who invests is a long-term optimistic person. Otherwise, just put your money in cash and head for the hills.
Yeah, great. Thank you.
Thanks so much for joining us. If you found this episode helpful, please rate us 5 stars, write a review, or share with a friend. If you're new to investing, make sure to listen to our first 10 episodes. Follow us at Get Rich Slow Club or Tash at Tash Invests or me at Ana Cristina.
This show was brought to you by Natasha Etchman, who is an authorized representative 1299881 of Guideway Financial Services, AFSL 420367, and Perla, who is an authorized representative 1281540 of Sanlam Private Wealth, AFSL 337927. Knowledge is power, especially when it comes to investing. So make sure you check out our financial services guides and read the product disclosure statement and target market determination for any investments you're considering. See our show notes for more info.